Your thoughts on UK assets? We've been very caught up in the conversation around the Bank of England and what the Bank of England could do to mitigate the effects of no deal. Mark Carney very keen to point out once again that there are limits to what the Bank of England can do. So what's your stance on UK assets right now?
On UK assets, we don't tend to take very much of a view on the pound from here. It is oversold, although there are downside catalysts, of course. We don't take a clear view on the pound in our portfolios, but we're quite positive on externally facing large cap UK stocks, which are very much out of favor, have very high dividend yields of close to 5%, and valuations are quite favorable. So that's where we're positioned in our portfolios in terms of UK assets, and we think there's more upside to earnings given the fact that you've seen a depreciation in the pound that's yet to flow through.
But how do you see the pound acting here, Supriya? I mean, are we looking at a situation where it heads down into October 31st and then maybe bounces back after another extension is granted, or what's your outlook?
Yeah, the move down in the pound, Matt, has very much to do with the increased probability of both a no-deal Brexit, but also a general election, which I certainly think has become a lot more probable, and a diminishing probability of a more orderly Brexit that, by the way, the Bank of England appears to have as its base case scenario. But that said, by any gauge of sentiment, it is oversold. However, this kind of signal will not provide enough information in a situation where you have a lot of political uncertainty weighing on the pound. So we are not taking a clear view on the pound in our portfolios, and we would rather manage risk around it than position either way.
Let me ask you what's going on. So an extension, the pound we've dealt with, FTSE 100, gilt markets. I mean, clearly gilt markets caught up in a number of different crosswinds, I suppose. There's the domestic politics. There's also the general downward drift in yields that we're seeing globally, and central banks generally being quite dovish, although the Bank of England is a little different. Columbia Threadneedle, I saw yesterday out with a note saying that gilt yields could easily go to zero. They're talking about the 2-year time horizon. They're saying recession risk is underpriced at the short end. What do you make of fixed income in the UK context? Because on the one hand, you could see money going into it as a safe haven, but on the other hand, if markets start to get spooked by fiscal promises from the government, other moves could be foreseen.
Yes, and I think right now gilt yields have taken their cue from the from the forces weighing on the UK economy rather, because we're in an investment slump. Weakening global growth doesn't help, and you have the prospect of the consumer finally buckling under because of more gloomy outlook essentially. So that's what it's reflecting. However, I do think that the room for the Bank of England to act is fundamentally more constrained than with other central banks, because they have to take into account the fact that the pound is plummeted, as well as the fact that you might have a more tight labour market. And so I think things are slightly different. Yes, we will probably get a rate cut or two, but it is more constrained. And I think the greater room for manoeuvre really comes from the fiscal side. So you will certainly get an increase in fiscal stimulus. And of course, that calls for higher gilt yields, although I think the economy will be the major factor here.